you could be wiser as an educated advisor. Hello everyone, I'm Steve Savant, syndicated financial columnist and money color commentator. On today's show, cash value life insurance and reverse mortgages, part 4 of our series on millennial tax-free retirement, all here on Let's Get Down to Business. Well, welcome to segment 4. Now we've talked about HSA accounts and Roth IRA accounts. Now I'm going to talk about cash value life insurance. This is a huge issue because you can take collateralized policy loans from your contract, and as long as you keep the contract in force for the policy insured, that money should be tax-free, and of course, withdrawals to basis the same way. There are 4 different chassis to choose from, and you need to really think about this from a risk tolerance test for your client and not just auto put them into indexing or VUL or whole life, depending upon what you like the best. You need to do a risk tolerance test first to find out, should they use participating whole life? Should they use universal life? And right now it's kind of fallen out of favor because of the low interest rate. Most people have been avoiding it and the sales are pretty low. Index universal life and variable life. They all are tax deferred. There is no tax deduction for this, so it's tax deferred, and the withdrawals to basis and the policy loans of collateralized policy loans of gain come out tax free as long as the contract's kept in force for the policy insured. And remember, you have to look at the product suitability for these 4 and which one should you use. If you have a very conservative client, you may say you may like indexing. You may show the math behind it. But in all truth, you have to look at the client's suitability, and if they're really conservative, it's probably going to be participating whole life. Now, the 4 chassis, par whole life and current assumption, are somewhat conservative contracts. Index is a little bit more moderate. You could lose money with an index universal life because even though 0 may be the crediting for the method for the crediting part of the account, I still have bills to pay in the policy itself. So just keep in mind, index is a great, I love indexing, I use a lot, but remember, I could lose money because of my expense loads in the policy against my 0 crediting that year. And the last one, variable universal life. I like this for young people that understand risk, look at long haul, and they really like the tax-free advantages. Now, when I'm looking at aligning your risk tolerance, you want to look at things like whole life for conservatives. They have non-guaranteed dividends, but they do have guaranteed cash value. And the last time I showed guaranteed cash value, which I was really surprised, the client was all over it. They really appreciated something that they could say, that part of the column is going to be for sure, that's guaranteed. It doesn't have dividends, but when you look at the dividend history of some of the top carriers that are out there right now, especially in the income play, these dividends have been really doing quite well. And if you put it up against the 10-year Treasury, of course, it really does quite well against that. Traditional universal life, again, it's kind of fallen out of favor because of the low interest rates, but index universal life, it could be a conservative alternative to the stock market because I have I have some downside protection. Again, I have expenses to pay, but I have some downside protection on the actual investment account itself. And remember, I could do foreign, I could do domestic indices. There's no dividend participation in indexing on cash value life insurance, so you can't get participation if the dividend goes great, but you have this downside protection, and keep in mind, I really like the idea, usually if you're going to hold this beyond 11, 12 years, you really don't have to worry too much about caps, participation rates, or spreads. They almost all coalesce right around the 10th or 11th year. So I don't want you to go out of your way to your client to say this one's better and that was the historicity thus far is that they pretty much all coalesce right around the 10th or the 11th year. Now, variable universal life, there are people that use this because they like the tax-free monies. They like to roll with the market. They understand it. They have huge, long horizons. You know, you're talking about millennials in their 30s. They understand that their funds, mutual funds and ETFs already reflect their risk tolerance, and they have a tolerance for this. So you may want to look at variable. And by the way, if you were looking at index, which is cheap and variable, you could participate with the dividend, but remember, you could also lose. So it's treated just like a security because it is a security. And then the last thing, when you're talking about not only participating, but it has high earnings capacity, and equity and bonds have their different formats that you can actually invest in and look at that as a possibility. So when I'm looking at these 2 areas, I'm trying to look at how can I make them work together. Think about it. We're looking at cash value life insurance, taking a loan out. But now, a kind of a similar situation is the home equity conversion mortgage, or called HECM. those monies are also loans from the equity position. You took loans from your life insurance cash values, now you're taking loans from the equity position. Both are under the same code. Both loans are not treated as income, so they're never going to show up on your 1040. And both of these product lines do not go over to the provisional income test. Think about it. Even municipal bonds are treated for income as far as Social Security is concerned, and it could trigger an alternative minimum tax depending upon the preference items that you're buying under muni bonds. So when I'm looking at basic concepts here, I can get a reverse mortgage. I could take it in a lump sum. I could take it for lifetime income, and all that's going to be tax-free. So I have a way of looking at this. And remember, generally, you're not going to see your Social Security or Medicare ever affected by HECM reverse mortgages or loans from life insurance. So it's really important to think about these are loans from a cash value contract, loans from a equity position in my home. Both of those do not count as a Social Security provisional income test for taxation. And you want to be able to look at, once I've taken care of my HSA, my Roth IRA, and I still have money to contribute, I don't have the same limitations on the cash value life insurance as I might have on a Roth IRA. So if I want to put on more than I do on my HSA or Roth, I can actually put more on my life insurance. And again, depending upon my equity position in my home, if I bought low and I've been accumulating, this is a great time to look at that for income. Most people that are entering their retirement are really looking for extra numbers, and especially sometimes they forget they should have really stalled their Social Security. Remember, the vast majority of American seniors are taking their Social Security at 62. Less than 5% are waiting till age 70, where they could have gotten a maximum return. So it's really important. Could I have went someplace else? I could have subordinated some of my income needs in my early 60s by using a reverse mortgage with HECM or a cash value life insurance, taking policy loans, collateralized policy loans out. I want you to think about our goal is always to defer Social Security all the way out to age 70. HECM and cash value life insurance can participate heavily in this, and it's a tactical move. Sometimes it's a standalone retirement issue in itself, but I use it a lot in tactical thinking because I'm trying to stall my qualified plan and my Social Security to age 70. The move could be huge for your client. That's why I can't overstress it. It's really the kind of thing that you need to look at. Now, remember, you have to have, this has to be your prime residence. You have to be 61% of the married couple, if you're a married couple, 62, and you have to stay in your home. And if you sell the home, then you're going to be subject to the same sales issues and taxes or whatever you're going to have for your house. My issue to this is, if you're going to buy a home or use a reverse mortgage and you're in your 60s, you should start thinking this is going to be the home I'm going to retire in. So, prime residence, can't rent it out. Must be age 62 or older, at least one. And this is a place where I recommend you need to start thinking this is your final home. And if you're like I am, once you move in your 60s, you don't want to move again. It's a hassle. Having tax-free income generated from your mortgage is a huge opportunity. And keep in mind, in our other HECM studies, there are other things that you can do with HECM besides income. You can actually buy a home or have an appreciating line of credit. There's a lot of HECM strategies to be had in retirement, and I highly recommend that if you're a senior, you need to kind of get yourself up to speed and educate yourself not only on HECM, but also on cash value life insurance. Most of the cash value contracts that we use now, these are not your father's life insurance contracts any longer. Most people use the lowest possible death benefit under the code, and so they can pull out tax-free. We've really learned how to manage the expense loads of life insurance. So it really pays now to really look at both of these. And again, they're not only standalone issues in retirement, but they could be tactical uses as well. And don't forget to watch our next segment, Protecting Social Security Benefits from Taxation, Part 5 of our series on Millennial Tax-Free Retirement. And keep in mind, before moving forward with any of the ideas on our show, always check with your tax consultant, legal counsel, and compliance officer. And don't forget to subscribe to my consumer show, Steve Savant's Money, the name of the game. Daily content that you can post on your website, social media accounts, and database distribution. I'm Steve Savant. Thanks for watching.